So it is my honor and privilege to bring on stage our next panelist, moderated by the host and founder of What Bitcoin Did, Peter McCormack, and Caitlin Long, founder and CEO of Custodia Bank. Put your hands together for Peter and Caitlin.
Wow.
Hi, Caitlin.
Here we are.
Here we are again. So it's been about 6 years now. You and I have been regularly meeting at things like this.
Yeah.
In a room with microphones, talking about Bitcoin, talking about banks, talking about the economy. And every time we meet up, things seem to have got a little bit more crazy.
It's our market. It's our environment, right? It was never going to be fun. They were never going to let us just take over money, right? So here we are.
But we're doing it.
Yeah, we are. And, we're all watching that it's likely that the incumbent banks are, and the large incumbents like BlackRock, are going to elbow out the small startups. So welcome to the USSA.
Okay, so we're here to talk about banking of tomorrow and the banks of tomorrow, one of which you're building, which we'll get into.
Yep.
But this is a year where we've seen some quite substantial banking failures.
Yes.
Let's dig into what happened there and what we can learn from that.
Well, number one, online banking took over, and it happened in the last decade. Pretty much everybody does everything online now. Bank branches, most millennials, and certainly Gen Zs have never set foot in a bank branch, right? It's all virtual. And it became a lot easier to move money at the click of a mouse. And it used to be that the bank regulators thought that bank failures would happen over a 2-week period. Well, we saw Silicon Valley Bank essentially fail over 2 days, literally 4 hours specifically. So Terra Luna failed in the span of 6 hours. It's all happening a lot faster than anyone anticipated. And the problem is that the basic model of banking is borrow short-term and lend long-term, take in a customer demand deposit and turn around and lend it out in a 30-year mortgage. And if all those customers want their money back, well, the Fed is there to back it up. However, the banks are supposed to be managing that risk themselves. And I was raising questions behind the scenes about, I saw Silvergate sitting with 10 cents in cash to back $1 of demand deposits, right? So when 10% of its demand deposits got withdrawn, that bank had to start selling assets at a loss. That's exactly what happened at all of the banks that failed. They had more withdrawals than they anticipated or were ready for, but they hadn't understand that the world had changed, and they should have, especially the banks that specialized in crypto, should have understood the bank run risk was actually quite high, and they really should have been sitting 100 cents in cash for every $1 of demand deposits, not 10 cents in cash. And your home country just mandated that for stablecoin issuers, but that business model is a business model the Fed called unsafe and unsound in January.
So was this an issue of negligence, or is this an issue of bad policy, or really a combination of the two?
It's a combination of the two. Yeah. I mean, I'm sure there were some people who understood like I did. It was pretty obvious when you look at it in retrospect. Go look at the financial statements of the banks servicing the crypto industry and realize, stop and think about, what if one of the stablecoin protocols had failed and there had been a sudden withdrawal of all those stablecoin assets? It wasn't difficult to envision that there was a lot of bank run risk at those banks. I think it's dangerous for traditional banks to be banking this industry precisely because of how fast the money moves. Even the U.S. dollar deposits, the plain old boring old U.S. dollar deposits, can move that fast. So the basic business model that makes sense is ours, and it's the one that the Bank of England just endorsed.
I thought after 2008, regulations were changed to prevent situations like this. I thought banks were meant to be stress tested to ensure we wouldn't see such a similar situation. Were the regulations not strong enough, or were the regulations wrong?
Well, the large banks the regulations were strong enough. It's the community banks. And see, we have these regional and community banks in the U.S. that the U.K. and most of the rest of the world don't have. There are 4,236 banks in the United States, right? If you think about the banking that you have in the UK, it's a small number of very large, national champions, to use that phrase. And I think that's where the bank regulators in Washington, D.C. want the U.S. banking system to go. They've certainly engineered what is likely to be an enormous wave of consolidation. And that's because the balance sheets are impaired. And that the balance sheets of the banks are impaired before we even get into a commercial real estate correction. So it's a pretty dicey situation. You see it in the bank stocks. You see it in the balance sheets of the banks in what's called the call reports. Their balance sheets have been eroded, and the community and regional banks were not subject to the same capital requirements. That's why the big banks came through this environment better, because they were forced to hedge the interest rate risk, whereas the smaller banks did not. So one of the things that I've done at this event is spend a lot of time with the miners, because Custodia wants to serve the Bitcoin mining industry. We are a bank built by Bitcoiners for Bitcoiners, and the mining industry has had a target on its back from the bank regulators in Washington, D.C. And it's tough for Bitcoin mining companies to get banking relationships. So I have to be careful because we're only licensed for certain activities in Texas. So I've got to give the qualifier that if you want to reach out to us to talk, please do. But there's only so much I can say in the state of Texas about our services, because not all of our services are available just yet in the state of Texas. And I respect the rules, so I can't overstep that. But we do, as a general rule, want to service the mining industry. And one of the interesting things about Custodia is we're not FDIC insured, which the average person would say, that's a problem, isn't it? Well, not.
Don't need it.
That's the point. If you're not lending, you don't need it. But I would argue that's a feature, not a bug, because Operation Choke Point 1.0 was started by the FDIC under the Obama administration under the chair, Marty Gruenberg. You've probably been reading about Marty Gruenberg in the newspaper in the last couple of days. There have been quite interesting stories about him. Okay, so but the FDIC obviously hates this industry and has turned down every one of those, including us, who tried to get FDIC insurance. So the benefit is that not being an FDIC insured bank, we're not under that pressure because the FDIC does not have jurisdiction over Custodia. And that's part of the reason why we can, I believe, have longer staying power in serving this industry, while so many of the other banks are under the pressure that happens behind the scenes in bank regulation not to service certain industries. And the Bitcoin mining industry, unfortunately, has a target on its back.
So explain what Custodia is as a bank. What is it you're doing differently?
Well, we are taking U.S. dollar deposits, FedWire, ACH, and government money market fund. So for those, our U.S. dollar deposit accounts are non-interest bearing. Again, check our website to see if they're available in your state. But then for those who want a yield, we are offering a government money market fund service for a very large brand name asset manager. And drum roll, we're offering Bitcoin custody. So you can do U.S. dollars and Bitcoin custody under the same roof. That is not available in the market right now.
Could I have a bank account where I can see my dollar deposits and my Bitcoin deposits together?
Oh, yes, absolutely. That's exactly what our brilliant designer built. Wait till you get a chance to see it.
Okay, so you're not offering interest, which at first sounds a bit odd, a bank not offering interest.
Yeah.
But, I mean, the interest rates, I don't know about anyone here, but the interest rates I've got in my banks over the last decade have been terrible. And it's not something I look for when I choose a bank. It's not something I think about. What I do think about is my money protected?
Right.
And I would happily pay a fee for that. Is that the model you're going for?
That's right. And so what's interesting is so many people in this industry, especially the miners, but just anyone who touches crypto, has been forced to just take any bank that will service them. And a lot of the CFOs and treasurers of the companies haven't had the ability to do the counterparty credit risk because they're just searching for bank accounts that will service them at all. But when you stop and think about, when you go look at the balance sheets of your banks, it's not difficult to figure out whether the banks are actually solvent or not, right? The problem is that the U.S. interest rate environment became so, the Fed went through a tightening cycle that was so fast that and so much money, they got whipsawed. You've heard the phrase whipsaw effect in the in a bullwhip effect, in the retail market, right? Think about the toilet paper shortage in COVID. What happened? Well, we all stayed home, so the toilet paper that was manufactured for the offices sat idle while there was a shortage of toilet paper for households, okay? And then they massively retooled to fill the demand of toilet paper in households, and then there was a glut of toilet paper for households, and then we all started going back to the office, and there's a shortage in the office again. Okay, that's called the bullwhip effect. It takes markets a while to adjust, and that happened here as well in the banking community with the interest rate environment, because the Fed injected so many reserves into the system, trillions during COVID. And the banks had to invest in something, but no one was borrowing. So what did they do? They lent it to the U.S. government, but they took long-term, they bought 10-year and 30-year treasuries. Well, they funded it with demand deposits. Okay, so when interest rates went up, those 10 and 30-year treasuries got marked down to, say, 70 cents on the dollar. Okay, so they had a 30-cent unrealized loss. Is the U.S. government going to pay it back? Yeah, it is in devalued dollars. Okay, but you see where the bullwhip effect it happened. All this cash went into the banks, and then they didn't have a place to put it, so they put it in long-term bonds because the short-term stuff back then was yielding zero. And then when the scare came and everybody wanted their money back, they had to start selling those bonds at a loss. And that's what took down Silicon Valley Bank. This is not rocket science, folks. It is amazing how bank regulators were watching as this happened, and we're not forcing the smaller banks to do better on interest rate risk management. And it's going to hurt this industry again because, like I said, there's going to be a huge consolidation wave in banks. I started my investment banking career in the 1990s, right after the Fed went through a tightening cycle. And literally since then, the number of banks in the U.S. has been cut in half. It's going to get cut in half again. But the impact to this industry, which is constantly kind of playing cat and mouse because the banks keep closing accounts under Operation Choke Point 2.0, the impact of this industry is that basically nobody's operating with just one bank account because everybody's afraid that the banks are going to debank them. Well, Custodia's here, the little bank that could, to fight against that. We don't have the FDIC pressures that other banks have, and we don't have those balance sheet pressures because we were never going to do that borrow short and long, lend long business model that I just talked about, which is upside down right now. And most of the banks that the small regional and community banks in the U.S. have real balance sheet impairment right now. But hell, if you're a company in this industry and you need a bank account, you can't afford not to bank with the bank that's going to open a bank account for you, even if it's an impaired bank. But you got to watch the counterparty credit risk.
So it sounds like you're building a responsible bank.
Yeah.
What a crazy idea. Why did the regulators, why have they throttled or attempted to throttle everything you're doing?
Well, I think if you read the public information, you can determine that it was Operation Choke Point 2.0. There is no question. And we knew about that the moment that the Fed denied us. It turned out we were the tip of the spear. But how did we know about it? I can talk about this a little bit more now than I could back then, because the government leaked it to the press, and we had reporters hounding us 2 days before the Fed voted to deny our application that we were going to be voted down. Supposedly, this is an independent Fed, right? Okay, but the White House was involved, we subsequently found out. And the impact is that because we weren't responding to the reporters, they finally emailed us and said, we have been told that every bank that has a crypto component has simultaneously been asked to withdraw their applications. Well, wait a minute. We were all supposed to be standing on our own, right? We have due process rights, and yet this was this coordinated approach across all the agencies. And now it's subsequently crystal clear it's a coordinated approach across all of the U.S. government agencies to try to kill crypto. But the funny thing is they failed. And so some of us are fighting. We're winning in the courts, obviously. So we've seen some of the court cases against the SEC. Still more to come. And of course, ours is as well against the Fed. And so, yeah, we're right now, unless and until there's a change in the Biden administration, we're stuck with the Operation Choke Point 2.0. I don't expect that to change at all. Even if Marty Gruenberg, there are a lot of people now calling for his resignation over the Wall Street Journal revelations, which are pretty salacious. And again, he's the guy who started Operation Choke Point 1.0 and Operation Choke Point 2.0. But even if he does end up having to resign over all those salacious allegations, I don't think we would necessarily get anyone any better.
It sounds very un-American.
It's very un-American. Well, and I ask, you know what's interesting, Peter? I'm glad you said that because multiple people have come forward to me. Washington, D.C. is a sieve. There are no secrets. We had the first insider come forward the weekend after the Fed denied us and told us everything that happened. And it was just very clear that what was happening to us was political. It was not on the merits. The impact is one of the other insiders subsequent to that, as I've been talking about this on podcasts, more insiders have come forward. And one of them, I asked the question, essentially the same question you just did. And I said, well, what is driving Elizabeth Warren to do what she's doing? And because he pointed out that she's basically in control of all the financial services appointees in the Biden administration. I can't prove this, but multiple people have now talked about it, including Novogratz, who's a big Democrat and has tried to meet with her, but apparently she won't meet with him. It's now it's not even a secret. It was an open secret for a while. It's not even a secret anymore. There was a deal apparently cut between Biden and Warren that she got to put her people in those positions. And as you know, she's very anti-crypto. And what was driving it? And the answer, the same question you asked me, was this person who's a moderate Democrat. He said they're all Leninists. They want a central bank digital currency. They don't believe in private industry, and they certainly don't believe in having any private banking.
But I remember when I first got into Bitcoin, seeing videos of Elizabeth Warren campaigning and taking to holding the feet to the fire of Wall Street, of the banks. And now she seems to have flipped in the last 2-3 years and now seems to be in the pockets of Wall Street and the banks. And I don't understand it because Jason Meyer's written a brilliant book about why Democrats should embrace Bitcoin.
There's some really powerful arguments by progressives for why they should embrace Bitcoin. Yes, absolutely.
So what has changed with her? I don't understand it.
So I've never met her. She was my law school roommate's favorite professor at Harvard Law School. She is a renowned scholar in bankruptcy law. I don't know what's driving it. And Ryan Selkis asked this of Novogratz, right? He's one of the biggest Democratic donors, and she won't even meet with them. But he said he's on stage when Ryan asked him at MainNet what's driving this. And Novogratz couldn't answer, but he said, I've talked to all of her staffers and they disagree with her. So she stands alone even within her office in how virulent her views against this industry are. The only thing that makes sense to me, and again, I'm speculating, I can't prove this, this is just what insiders have come forward to tell me, is that she really wants to tear down to build back better. And that definition is that there will not be any private financial institutions and we will all be banking at the Fed. And they will be able to turn on and off our access to our money based on what they desire. That's what Operation Choke Point 1.0 is, and Operation Choke Point 2.0 as well. Right? It's basically saying certain industries can get access to their money and certain industries cannot. Wait till they do. Certain people can get access to their money and certain people cannot. I have heard of individuals who've had bank accounts closed just for, sending a wire to Coinbase and the like. So that happened to you? Yeah.
Three times.
Yeah. Right. See, but I mean, this is what we're fighting against, all of us. We need to fight against this. I adamantly do not believe in the politicization of banking. If there are fights like abortion or firearms that we want to fight out, you don't fight it out by controlling the banking system. You fight it out in the Houses of Parliament or Congress, right? That's where you fight it out. You don't behind the scenes pull the strings on the banks, but that's what we're up against, right? And certainly it turns out one of my other law school classmates was the attorney who sued the FDIC over Operation Choke Point 1.0. And one of my other law school classmates is our attorney in our lawsuit. It's ultimately, similarly, it's about some of the same things. There's been a centralization of control in Washington, D.C. It's taken power away from the states, and the states are fighting back. And that's what Custodia is. That's what the Wyoming Special Purpose Depository Institution Charter is. There are 6 U.S. states, 3 red states and 3 blue states, that will charter uninsured banks. And the Fed has stymied all of them. So what's interesting is our fight is not just crypto, right? The SEC, if you think about the Coinbase fight, it's essentially reopening the Howey test. That could have implications far beyond crypto. Our fight is analogous in the sense that there are multiple uninsured state-chartered banks that have been blocked by the Fed, and only a few are crypto. The others are not crypto. They just happen to be tech-forward fintechs, and they've been blocked too. There's an Idaho bank that's doing a very interesting fintech business tied to API calls for customs. So when goods clear customs, there'd be an API call, and the invoice would be generated so that the payments can speed up in the supply chain. Sounds like a really interesting business, but it's uninsured, the Fed said, and so the Fed denied it. And this is that one happens to be in Idaho. There's one in Vermont. There are multiple in Connecticut. So it's a collection of states. It's not just Wyoming, and it's not just crypto that this all has implications for. And we're fighting over a statute that requires the Fed to service all eligible depository institutions that was passed in 1980, back when the Fed was begging Congress to require every financial institution to hold reserves at the Fed without exception. And that statutory language is still on the books. It hasn't changed. What changed? During the Obama administration, the Washington, D.C. federal bank regulators started to reinterpret the laws to give themselves the power to pick and choose which industries got to bank, and to pick and choose which states get to have state banks that can access the Fed.
Well, why does the federal government seem to work on such big policy, big infrastructure projects that seem so anti-freedom?
Well, because the Washington, D.C. is bureaucracies are all about expanding bureaucracies and expanding power. By the way, one of the other interesting inside baseball things, there's a stablecoin bill that's been winding its way through Congress behind the scenes that possibly, I understand the chance is like 50-50, but possibly could get done as part of the omnibus bill. And guess what? The Fed made a play to become the sole chartering authority for stablecoin issuing banks in the United States after rejecting us as a unsafe and unsound business model for being a non-lending stablecoin issuing bank, which is exactly what the Bank of England just said it required. The Fed behind the scenes was making the play to be the sole chartering authority for exactly that. Okay, and so they lost. They apparently threw the baby out with the bathwater, I've been told. I can't prove this, but this is the inside scoop in Washington, that they didn't want the states to be chartering these, right? So there's this creeping centralization and creeping reinterpretation of the law. And if nobody's challenging it in court, then the agencies just continue to accrue more and more and more power. And that's what's happening.
So how do you fight back then against this? Because as I said, me as somebody who keeps coming back here, it seems very un-American.
Yeah.
It seems very anti-free market.
It is.
The Fed itself is meant to be independent of government, but they've weaponized the whole banking system against the electorate. How do you fight back against this?
Well, there are, in the wisdom of the founding fathers of the United States, 3 equal branches of government: the executive, the judiciary, and the legislative. And so with the legislative branch being tied up with different political parties being in control, the judicial branch is the one that's available. And that's where we've seen a lot of action against this coordinated government crackdown on crypto so far. So the courts have actually really, probably more than a lot of people anticipated, shot down what these U.S. government agencies were doing under Elizabeth Warren's direction.
And what about the CBDC? Because this is obviously a big issue. We all understand the concerns with CBDCs. None of us want them. I am aware, I think in Florida, didn't DeSantis legislate that it cannot happen there? But can the federal government overrule that?
Oh, boy, that's a whole can of worms. The Constitution defines the dollar as a particular weight of gold and silver. Go read Article 1, Section 10 of the U.S. Constitution. So it's a really interesting question whether the dollar itself, being fiat-backed, fiat as in not backed by anything, is even constitutional. Okay, so if the states want to start fighting back on those things, there is a whole potential can of worms that could be opened. And so if let's just play it forward, let's say there's a second Biden administration and Warren has another 5 years from now of controlling crypto policy in the United States, and a CBDC gets issued, then what are the states going to do? They're going to be fighting back over the constitutionality of all of that.
And what about people here? What can people here do?
Just keep building and keep folks alive that are willing in the banking industry to fight the fight and to support this industry. Custodia, of course, is not alone. We just happen to be the target of wrath because in some ways, they shot the stallion to scatter the herd, so to speak, right? They did it to Coinbase in the security side. They did it to us on the banking side because we were the two that were the closest to getting regulated. And so they wanted to scare everybody away. They wanted to intimidate us to go away. And what did both of us turn around and do? Found ourselves in court. So here we are.
Okay, so just to wrap up, back to Custodia.
Yep.
How operational are you now?
Oh, we are operational, again, in certain states. We're not FDIC insured. I've got to give those disclaimers. We have U.S. dollar services, government money market fund services, and Bitcoin custody. We are live with all of those things. We will be releasing our APIs, hopefully by Q1, and adding Prime services by the spring.
And what are those Prime services? What are the others?
It's essentially connecting into the exchanges. We are not an exchange, but if you think about it in the securities industry, Bank of New York Mellon or State Street are the custodians. The New York Stock Exchange or NASDAQ are the exchanges. Two separate, right? But connected by technology, and that's what we will be as well. But the great part is with us, the U.S. dollar piece is under the same roof.
Okay, last question. So will Bitcoin fix this?
Of course Bitcoin will fix this. I don't think any of the banks will be around at some point, probably during our lifetimes, as for the young folks out here. I don't know about for a Gen Xer like me, but for the Gen Z, probably during your lifetimes, technology is just going to overrun all of this forced intermediation of financial services. But between now and then, I don't think it's in anybody's interest that the two sides end up harming each other, which is part of the reason why I'm trying to build good bridges. But to quote Jesse Powell of Kraken, sometimes when you build a bridge, you don't need it anymore and you blow up one side of it after you're done using it. So.
All right. Well, look, round of applause. Thank you to Caitlin Long.
Hey guys, thanks for coming out to the 2023 North American Blockchain Summit. It was the best summit yet. We look forward to hosting you again next year. If you enjoyed the summit or like what you saw in this video, be sure to subscribe. If you're interested in learning more about membership in the TBC, go to texasblockchaincouncil.org to learn more.